Good evening, everyone. Welcome to a special live episode of World of Oil Derivatives. I'm Greg Newman, Group Chief Executive of Onyx Capital Group, and your host for this evening. So first off, why the live episode on a Sunday night? Well, this is when the financial oil market opens on exchanges after a weekend of being closed. Over this 2-day hiatus, the market has time to digest news, consolidate and prepare trading plans for the following week. When a significant market event occurs over the weekend, traders cannot react instantaneously and they have to wait, sometimes painstakingly, until the open on Sunday. If the news is perceived as binary bullish or bearish, the market reaction on the open can be very aggressive, as consensus has built and traders with risk on who need to get out, or speculators wanting to get in, are all scrambling for the same one-sided liquidity. The exchange begins trading at the price that satisfies all the orders that have been placed at the pre-open. So if there are a flood of buy-side orders coming in at once on the open, then it could trade a lot higher instantaneously. And vice versa if there are a flood of sell-side orders. This was hugely significant in the attacks on Saudi infrastructure in 2019, which saw Brent prices move up $10 immediately on the Sunday night open, and it stayed volatile all evening. It was a similar case, but the other way, with the price war during COVID pandemic in 2020, where prices fell around $10 on the Sunday night open. Now, as I'm sure everyone knows, tensions in the Middle East have been reaching boiling point, and consequently a geopolitical premium has been present for the last few weeks in the Brent price, trading around $6 higher than before Iran struck Israel on October the 1st. The market was holding its breath for retaliation, and this has now come with Israel striking Iran on early Saturday morning. So what will the market reaction be? How is the market positioned going into this open? How is this news likely to be taken? Leading up to the open at 10 p.m, we will be answering these questions as best we can. We have Mita and Martha here from the research team in the studio, and we have Jorge all the way from Dubai dialing in, and Harry from his home in London to give us his thoughts as well, before turning in to the market at 10 p.m. So let's start off with a summary and recap of the attacks this weekend. Mita, what happened?
So, as you mentioned, so at midnight on Saturday at midnight London time, we heard of initial Israeli strikes reported in Tehran, targeting military bases in the west and southwest of the city. The IDF confirmed precise military strikes on targets in Iran, which then extended on to the southern city of Shiraz. And eventually, there was a third wave of strikes involving around 100 Israeli aircraft. So there were fatalities. 4 soldiers, I believe, were reported to have been killed in the attacks. And these were focused on military sites tied to Iranian missile programs. But as the market was fearing essentially targets on Iranian oil and nuclear facilities, which did not happen. These were targeted. These were limited to Iranian missile programs and Iranian military facilities. And eventually, following the third wave of strikes, the IDF announced a conclusion of operations with their mission objectives achieved.
Retaliation complete.
Exactly. And the US confirmed that it still believes that Israel had the right to defend itself as it has been going on, and that the operation was independent but coordinated in scale and strategy.
Okay. So I guess this is obviously very important, but it's about the reaction and people's belief about what the reactions could be going forward. It's been this tit for tat thing. So Martha, what's the officials like? What have they been saying after this?
So looking to the Middle East, Iran itself has come out, and the initial reaction on social media, which is terrible to reference, but from the political elite of Iran was fairly mocking of the strikes, which we did see in April, which we saw as kind of downplaying their possible reaction to it. It's well, why would you respond to that? But then also at the same time, the foreign ministry of Iran has been referencing the UN Article 51 and saying they have a duty to respond to this. So they're kind of coming at both sides there. So I think it's worth, it's not completely discounted. It's not, their reaction is not null necessarily. And then outside of Iran and the wider Middle East, we've seen a fairly ubiquitous response from the oil producing countries in condemnation of the attacks, but very, very heavy on the de-escalation, a halt to escalation in the region. Security and stability is just the lines that each of the countries have come out with. I think the Saudi UAE
It's
all of
interesting you said
those.
it in itself, because producing countries, oil prices and the impact, they're kind of two agnostic things in a way. But let's look at the Brent price for the last few weeks, because we were down at 70 on Brent and almost went through it. And it was a big downtrend, looked like to be a consensus move downwards. All of a sudden we got this rally, didn't we? So do you want to just go through the price action last few weeks, Martha?
Yeah, of course. So yeah, as you said, on October the 1st, we looked like we were going to be breaking past 70 meaningfully. And then there were the initial Israeli strikes in Tehran. And then we saw that initial kind of bullish momentum build in when the market was really, really short and this kind of bullish news was ready to be received. But then in the past few weeks, we've seen kind of maybe some pricing out of the geopolitical risk when there have been statements coming out emphasizing the US especially cautioning and then essentially the promising of not hitting the nuclear or oil sites that you mentioned before. So we've seen the really range bound regime in the past couple of weeks.
Yeah, I think the interesting thing is like so much promise in a way of something huge, but it can't, even if the market's really short, which it was, and we had this big rally, it can't stay buoyant forever, right? We had quite a long time waiting for this retaliation. So we had this natural kind of sell-off as that wasn't materializing, but has since stabilized, I guess, in the last week, like you say. There's a few more dynamics at play. Of course, we love talking about flows and positioning. So let's get into that. Harry, from your home, what about positioning sentiment? Could you give us a run through of that, please?
Well, certainly sentiment in markets has generally been dominated by the very poor macro narrative centered around China. And as far as the oil market goes, we've seen a lot of hesitancy by managed money to deploy risk and put on length. And they've gingerly put on length whenever geopolitical tensions rose and there was some perceived risk potentially to either oil production or transit. And so now we're in this situation where that geopolitical bubble is sort of burst. And the thing that we're going to be looking at, given the current positioning, is whether or not the narrative, the macroeconomic narrative, is not going to take over fully what's happening in markets. And this is a question mark in the sense that if the macro is weak, perspectives on oil demand are weak, perspectives on oil supply are strong, we may be looking at a market that's going to be heading very quickly to the 70s and even possibly test the 60s handle.
Great. And what about options? This is that you were talking about on LinkedIn. If we can go a bit more into detail around that. First of all, why is it important? Why should people care? And I guess what we're looking out for.
Oh, absolutely. What's remarkable with the Monday Open following this kind of an event is that it is, as you point out, option expiry day for the December futures contract. So options on the December futures contract for Brent are going to expire on Monday. And so we look at clusters of open interest on selected strikes or strikes that are close enough to the current price action. So I believe we closed Friday at around 76.05, I think. That's where we closed. And so you have a lot of open interest on put options at 75 and $70. So
Harry,
if
just
the
a
market
second,
starts opening,
so we'll just get that graph up if we can, just because we have that for what you're talking about. The open interest around particular strikes. Here we go. Sorry, Harry, continue.
So as you can see on this chart, especially looking on the left-hand side, there's decent open interest at $75 per barrel and also 70. Now, the biggest amount of open interest is on 60, but what we're concerned with is that 75 and potential $70 open interest. Because if the price starts coming down, the underwriters of the put options are going to manage the delta of the option. And as that delta starts increasing, what they're going to be doing is selling futures against their short put position. And that could lead to what are called negative gamma effects and effectively a snowballing effect in selling that could quickly bring the market down. So the question is, we have to first move to 75, and we'll see how hedged the market is relative to these options. But there is obviously an element there that on top of the pessimism, the macro pessimism that takes over, where you have a flow effect in the market as a result of option hedgers getting in there, selling futures against those put positions.
So just to make this a little bit simpler, I guess it's these key figures, right? So we're going to open, and then if it approaches, well, we're at 75, 76, so there should be quite a lot of activity anyway. And this is a big part of why we think this is an interesting open, because there's a lot of people positioned and need to react either way, even if it's just to manage hedges. But if we go to 80 or if we go to 60, the closer we arrive to those two figures, one way or the other, the more the hedging activity comes in from these option underwriters, like you say. So essentially, if someone doesn't want to see something happen, we want 75 just to trade around there. But if it aggressively moves up or aggressively moves down, it could get progressively worse very, very quickly. And let's not forget, again, another thing everyone seems to talk about these days are algorithms, right? And momentum trading algorithms. And they're going to chase any move we see tonight. And because it's in the middle of the night, it's going to be quite thin volume, isn't it? It's not during the peak of the Europe day, which is where we see the majority of the liquidity. So this could be quite an aggressive move that will exacerbate the further we move away from where we are right now to 80 or to 90. Is that fair to say, that kind of summary?
Yeah, absolutely. The movements could be very abrupt because obviously the liquidity is thin. We know that in Asian trading hours, of course, the number of participants are a little less, and when Europe wakes up, and then definitely when the US gets going. So if we start approaching that 75, and you do have that basic negative gamma to be covered, then the algos could indeed be a reinforcing factor in the
Yeah.
price move. So we'd be looking effectively at a snowballing effect. Now,
Mm-hmm.
we can't tell for sure how much of those 75 puts have already been hedged, so that the next real move would be maybe around the 70. But as soon as the price gets closer to those strikes, what you tend to have with that hedging movement is that eventually the price will sort of bounce up and down around that level.
Okay. We actually have CAT positioning here. So on this topic, here we go. Martha, do you want to just go through what's going here?
Yeah, of course. I apologize for my Excel graph. But you can see the green line here that's the total CTA positioning like model estimation for a group of futures, which kind of represents the movement in flat price a lot in terms of the net positioning. Sorry, the net positioning of the like crude flat prices a lot. And we can see here I would say it's low, but not at its saturation lowest. I think there is room it could sell off, pretty sharply. We see it kind of creep up and then sell off very sharply recently. And I think there is definitely room to go lower. But yeah, I think
this backs up what we were saying about the graph, right? So about the 11th of September, it looks like it peaked on the short side. Am I reading that right?
Yeah, so I'll just almost 12th.
Okay. So actually, the 1st of October is when we got this huge rally, right? Actually, the market was still net short, but not as short, I think, as people were saying. It was starting to actually people profit taking whatever it was before then. So that's quite interesting. But either way, this is a good example of, just showing how things can move to the extreme. So I guess the summary of this for me is we've got a way to go both ways. So if there's an aggressive move upwards because of the market sentiment, on the open is quite bullish, then it's got a way to go, and vice versa. So it's not like one saturated one way or the other. I think that's pretty key. Just going back to sentiment, Harry, as I was saying before, we had these strikes. I think the interesting thing again about this open is it's one of two ways, right? We have the backdrop of a very bearish sentiment that was taking us down potentially below 70 already, and that decline got arrested, and then suddenly there's a lot of bullish people. So you've got yin and yang in a way. Could you just talk us through the sentiment and the backdrop of this, not including the Israel-Iran situation, the consensus view outside of that? Sorry, Harry. Sorry, Harry, can you start again? We switched to the other guy.
Well, we're live, so these things are bound to happen. So, it's been something that's been in the market narrative now for some time, but we're just getting more and more confirmation of it, is obviously the weakness of China in terms of its economy. And given that how important China is in driving global oil demand, but also demand for industrial commodities, confirmation of that weakness, its deflationary background, disappointment when it comes to government measures in terms of fiscal stimulus to prop up the economy. The figures we got in terms of GDP growth for China in Q3 were disappointing, and it's very unlikely that China is going to achieve its 5% growth target. So you add to that extreme weakness in Europe, as we know, the composite PMI that came out for October don't paint a pretty picture for the Europe's largest economies, Germany, France, or the Eurozone as a whole. And to add to that, and perhaps this sounds a little bit contradictory, is that you have U.S. exceptionalism where data in the U.S. is doing a little bit better than expected, if not stronger, if I could put it that way. And that just means that the Fed's easing cycle may be compromised in terms of the pace at which people were thinking it would take place. So if the Fed is no longer in a rush to ease policy, bring down rates, that's a little bit of a negative. It's strong for the dollar, and of course we know, generally speaking, a strong dollar environment is not too good for commodities that are denominated in the currency. So that overarching narrative was there, taking us down to the 70s. We had the attacks by Iran on Israel on the 7th of October. The geopolitical risk premium propped up prices. And here we are with as Martha and Mita explained, an outcome in terms of Israel's retaliation that could not have worked out any better for the US in terms of the advice and guidance that it gave Israel, and in terms of preventing an escalation between the protagonists that would have been a tit for tat with greater and greater risk of miscalculation that could have obviously spread to worse things for the region. So that is what we're looking at now in terms of the general direction. Add to that, of course, that OPEC may or may not add more barrels back into the market at the end of the year, and that just adds further to negative sentiment on oil prices.
Great, thank you, Harry. Very measured response, I think, from everyone. But let's go to Jorge to get a less measured response. We like his entertainment and his viewpoint. So Jorge, just in general, what's going on? What are your thoughts? You're in the Middle East. It's a great place to be for this in terms of commentary. And could you bring in the underlying market as well? Because on the backdrop of a consensus bearish view in the outright price and the macroeconomic environment, in the prompt physical crude market, it's actually looking pretty strong, right? Or at least propped up. So in general, could you just give us your thoughts?
Yeah, I have spent a little bit of time today talking to various traders who are, of course, going to express their point of view in the next few minutes. But the overall on the market.
Oh, I think we've cut out.
Israeli attack was
sorry, Jorge, just a little bit of Wi-Fi issues there. Could you just go again?
Yeah, the overall market view is that the Israeli response was underwhelming. I even heard such words as wimpy response. And when you're in the middle, that's a term that, of course, you're going to hate very much. So in the middle of all of this, as Harry has been indicating, we have a backdrop of very bad negative macros. And also some physicals that are looking terribly strong. One of them has been Dubai, where one of the entities that Harry used to work with, Total or Totsa, has been buying a lot of Dubai, creating a strong backwardation, suggesting that the market is short. But talking on a broader basis, it doesn't look like the market is short. So is it a narrative? Is it an actionable event taking place in key benchmarks or not? But talking broadly in the market, it does seem that the market is long, and that what has been keeping it up is the fear of a broader conflagration in the Middle East. And a lot of people that are not as old as some of us are have been talking about closures of the Strait of Hormuz and really cataclysmic events. And as you study the history, you realize that closing the straits is a very difficult thing to do, and that dozens of tankers were blown up in the past in the late 70s when Iran and Iraq were going at each other. So physically and technically, logistically, you can create a lot of issues in the Middle East, but it's in the Straits of Hormuz, but it's very hard to really stop oil from flowing. Take the example of Ukraine and Russia. They blow each other's oil facilities and pipelines, and oil somehow finds a way of going out. So we went into this event of Friday night with people thinking that things could be bigger than they actually were. and that even if they had been big, that they would be very disrupting from an oil flow point of view. And my overall thesis has been that nobody wants to see a big war in the Middle East. Nobody wants to see any further cutting back on production and flows going through both seas, and that nothing big was going to happen. And what we saw is that nothing big is going to happen. So I would say from the people I polled today, and this is the punchline for you guys, is that about 70% thinks that the market is going to dump at the open because nothing really happened. And 30% says, well, it's priced in, and maybe there is going to be another retaliation down the line. And look at the latest pronouncement by the mullahs, or look at the pronouncement by the IDF. But I would say, as a whole, the sentiment overwhelmingly is on the side that this market is going to start reflecting more of the macro fundamentals that Harry was talking about. Back to you, Greg.
Great. Thank you, Jorge. I think we'll come back to you about price predictions. But just before we do that, it's not just about the outright price, right? It's not just about Brent and WTI. Jorge's mentioned, the underlying crude market having a bit of support. What are some other markets that have been impacted in this last few weeks?
I think it's really interesting to see the middle distillates complex right now. So ICE gas oil specifically. If you look at ICE gas oil cracks, they've also been struggling with this dichotomy between weak macro fundamentals in Europe, with weak manufacturing data coming out in key economies such as Germany, while at the same time you've got this risk of supply disruption due to everything happening in the Middle East. So just having, if you just look at the deck crack, for example, ICE gas oil.
Yeah, we just got it here.
Yeah, so no worries. Take your time. Yeah, you can see that big spike just after the 1st of October, around the time.
Could we actually zoom out even more? Because I think the gas oil crack this year has been a very interesting one. It's finally been going back to quotation marks normal levels, right? So here we go. So we were up towards 20 at the beginning of the year. We've come all the way down, but you did get a spike on the first nonetheless, which has probably faded more rapidly than Brent has.
Definitely. So with manufacturing data being so weak in a lot of Europe.
It's hard to deny.
Exactly. Yeah. So if you can see around mid-September, the crack fell to, what was that level? Like $14 a barrel. So yeah, I'm fairly certain that spike at the beginning of October a lot of it was linked to geopolitical risk. And then you did see an up and down throughout the month with just how traders were pricing in weak data versus, this could happen again. What's happening with Israel? What's happening with Iran? And so because of that, I think there definitely has been some form of floor to prices in the deck crack because of it. And it's going to be really interesting to see how this is going to react in the coming week as well.
I think if it's been moving down, a lot of the year, and a lot of people have been short it, and quite happy to be short it. It's moved up and moved back down quite quickly, which makes me think the market, can sustain this buying flow as probably quite a way to go on a momentum basis, which is pretty interesting. I think you'd probably say the same thing for gasoline. Gasoline has been a lot of bear talk lately, and it's been riding pretty much exactly the same path. But I think the one worth mentioning in particular is fuel oil, right? So shipping fuel, high sulfur fuel oil in particular, big rally in the crack. Positive for a time. I think the first time ever in M1 crack, if I'm not mistaken. That's been hard to understand in some respects, but undeniably, if there is going to be real impact of oil in the Middle East, the Straits of Hormuz, one of the biggest impacts is not just crude, it is high sulfur. It's kind of fair that you'd rally, but it's such a big rally. The market is so long, from what I'm hearing in our data, that this has to be a vulnerable one, right? I guess we can go to the graph again on here as well.
Yes, so this is more long-term again, and you can see there was this, there have been these huge rallies over September and then over October again. I think this one in the fuel oil crack kind of kicked off mainly was the week before last, where we've just seen these like incredible buying from like a range of players, and kind of it's been taken. So there was the Middle East situation. I think there was some positions in like the Arabian Gulf being removed.
I believe a lot of the strength is also because of a closed arbitrage. There is supply tightness that's dominating the market right now. I believe a lot of it's from the US, but definitely with the Strait of Hormuz being so important for fuel oil, a lot of this it'll be interesting to see how the market open.
Yeah, it is. And it will take a while for people to trade this. But having said that, the high sulfur fuel oil crack does have a historical correlation with Brent, and quite commonly traders will trade Brent with it alongside. So you're long the cracks, you're long flat price. So you tend to see an inverse relationship. And as you see at the beginning of September, that very sharp movement upwards from quite a relatively low level was actually to do with the Brent sell-off, probably most likely, right? People trading it interchangeably. And then as we retraced, actually it kept going and became positively correlated. But that's very unusual. And that's a very strong signal that really the underlying fuel market really wants to own this. So I think the market being long, the market starting to do well, is taking every opportunity it can to, continue buying. And that's probably what happened. And to some extent, a long market in the swap market is different from the long market in Brent, because ultimately you can buy these swap contracts and price them out. You don't actually have to sell them back, which is what makes Brent futures so vulnerable, right? Hedge funds who own it, they can't hold it to expiry, or they don't tend to do that. So they have to get out at some point, which makes a very long market, quite risky. Whereas on the other hand, swaps, if they're overextended, if it's close to pricing and the physical's there, it can actually follow through. So it'd be very interesting to see. But this is, you said the arbitrage closed, East-West being so deeply negative, very unusual. The crack being so positive, very unusual. So if there's going to be a serious unwinding in any of the swap contracts, I think the fuel one's going to be one of the more interesting ones. Okay, we're getting 5 minutes away. So just before we obviously turn to the market, Jorge, can we get a bit of drama? What's your price prediction? What are you thinking? We can't hear you actually, Jorge. I don't know if that's... Sorry, can you just hold on 1 second?
Okay, I'm back here. No, I was laughing because one of the last entries in Twitter was dive bomb trading. So by maybe focusing on that, I would say that any possible action that I would consider reasonable is to sell the contract. Okay. We're going to be, in my opinion, pursuing a number starting with a 6. Whether we do that immediately over the next few minutes is a hard thing to jump down to, but it's something we're heading into, because we are going to be seeing greater allocations by the Saudis over the next few weeks. The Chinese are very mindful to say that it all depends on price. And they will nominate, of course, for more crude if the price by the Saudis is in the right location. And the Saudis have confirmed to us that they will pursue a policy of selling more crude for the December lifting. So that backdrop is negative. The action in the Middle East has been negative. Let's not forget that a reaction by any combatant takes a long time. It's weeks of preparation. Weeks of harnessing war material, getting the planes ready, getting the defenses or attack ready. So if you put it all together, the market is going to wake up maybe today and say, let's sell this baby down. Back to you.
Give us a prediction. Back to you. What are you thinking in the first? As soon as it opens, where's it going to open? No, you're gone quiet again, Jorge.
I think it's going to open in the 73.50 level.
Okay, nice. Harry, over to you. What are you thinking?
Very, very smart. I was just checking out, actually, it's a Twitter handle of Dive Bomb Trading, and he reckons that according to his technical chart, we may end up at 68. Well, I'm a little bit more measured than that, of course. I think on the open, we could easily lose a couple dollars. I think, last Friday we had a net gain of $1.67. I think we're going to wipe that out fairly quickly. And so I think we lose $2 quite rapidly, then a third. And then, as we were talking a little bit earlier, we passed the 75 mark. So any hedging relative to puts on that level would have been taken care of. The next question is if we have a dramatic scenario that goes towards testing a 68 handle, that's where we can have an acceleration down and see that happen. But I'd say we knock off $2 to $3 relatively quickly.
And then what do we do throughout the rest of the day?
Well, defend the 70 line if we can.
Okay. What do you think, guys?
Definitely bearish, as you've all said. I don't know if we're going to go down to 68 already, but I think we're going to see some support at 70. I think that's still going to be there.
Same as you, Martha, or got a contrarian view?
I'm not contrarian on this, sorry. Yeah. I think we'll probably see. I think I have hope in 68.
This is on Brent. You think it's going to open at 68?
Oh no, I thought you meant like by the end of the day.
Okay, yeah, by the end of the day.
My bad.
Oh no,
Sorry.
where's it open down right now? This is the quickest way to be wrong. We've only got 20 seconds.
Oh my god, yeah, $2 now.
$2, yeah. I think the consensus has been $2 lower. I think some people think it's a bit of a non-event, which is surprising to me because, you know, there's a lot of open interest. There's a lot of interest, and I think people are generally wanting to be short. So I'm surprised people are saying that. We've got 5 seconds. Hopefully we can go to the graph right now. This is using investing.com.
This is TradingView.
Sorry, TradingView, my bad. And we've opened, unfortunately, it's not showing the data, or is it? ICE is open, it's down $3. So, yeah, that's Jorge wins that. Well done. 72.82. Just keep, it's going south. Unfortunately, guys, we can't get the data. It's not so easy because obviously ICE licensing and the rest of it. But hopefully people are watching. We're still going down even further. $3.50 now. Okay, so Jorge, what do you think? Probably what you expected, right? Do you think we keep going?
That's more.
Now you were in, you've gone quiet
the
again.
number is coming in roughly where it should open, which is below 75, right? It's where we need to go. And then, as Martha is saying, people are going to fight that number, but inevitably will be in the with the $6 handle.
But it's still going lower. I mean, we're
here,
approaching 72 now, so we got a way to go before we can say it's stabilized. Anything else to add? I mean, have you watching anything on gas oil crack? If we can maybe grab that up.
Yeah, of course. I'll get those prices up now.
And Harry, what you thought as well, or it's beyond your expectations?
Well, it cleared faster than I thought. I thought that we'd lose a couple dollars from the get-go, and then yeah, you'd have a little bit more defense of the price. But I think we passed the 75, or obviously a lot of clustering of open interest there, and we're now getting to 70. And I guess really the question is, do we undershoot 70? And you know, every time you have an option expiry, you always have that in fact where you have overhedging by the underwriters of these puts. So you could have that move down, exacerbated by algos and other systematic trading before it settles back to the 70. So I think really, you know, we're just at the very beginning. And we have a long day ahead of us before we you know, before we conclude. But we did give up the gains of last Friday, and interestingly enough, you know, we're trading back at the levels like we discussed at the beginning of the show, where we removed that geopolitical risk premium that everyone was worried about. Israel did its thing, followed U.S. advice, and at the end of the day, we're not going to have an escalatory scenario between the two protagonists, right? So we're trading at that level around $72, which was the level of the macro narrative, and looking to push lower. I still think we'll defend 70. Whether we get a 60 handle intraday, possible if we have overhedging. But maybe we settle around that 70 mark on option expiry date. That would be my take.
So we're also down on the spreads. We've got, you know, 10 cents a spread essentially in the front for Brent. That's pretty unexpected as well, given the market's been relatively strong in the prompt. Jorge, do you think that's a buying opportunity given what's happening in the prompt?
I don't think so, because the flat price has to signal a number, and via the spreads that oil needs to be bought and stored. So the narrative that we have been providing in the officials is that the market has to go into contango. Of course, these things are not a one-line travel, neither is the flat price ever. But it has to go into contango. So we're going to crunch in. The physical in dated Brent has been signaling a little bit of negative sentiment, where it has been at flat or even minus, one could say. And futures has been holding up, and they need to converge in that in those spreads. So expect further weakness.
Okay. You guys watching X? I mean, the dive bomb trading?
Yeah, I'm scared to share my screen with the OOTT Edge X, but I think there's lots of graphs with lots of lines on from some technical analysis, and this is the one that Harry was referring to earlier. This is not Brent. But yeah, there's lots of that, lots of opinions. A few people saying this is a buying opportunity.
Right. Okay,
but I think buying opportunity for their Bitcoin. Probably, I don't know. Like, they're people. Everyone's trying to sell you something, so I'm just taking it with a pinch of salt.
Well, I'll be honest, it's a big move, but it's relatively tame. I'm surprised people aren't talking about it more. But this is when you have so long to digest something, then the market sometimes can be just relatively muted. So what's this? Sorry?
Harry's on.
Yeah, nice. Great. Okay, well, I guess unless there's anything anyone else says, any closing thoughts, Jorge, for people for their trading day?
I think most people need to start considering the fact that the Straits of Hormuz are not going to be shut down. They have to consider that all the signaling has been given to Iran that the attack would not be disastrous to the country and that they should temper the response. We're going to hear a lot of noise and read about this and that when the oil price falls quite hard. But the fact is that all the adults in the room do not want a greater tension and increasing bombing in the Middle East. So between here and the election, I think we're going to have some calm markets. Not that we are not going to see some minor ups and downs, but we're going to be heading down on the line. Some people are also forgetting that Trump is going to increase tariffs if he gets elected, and he seems like he will get elected, and that he will be confronting inflation. One of the elements that is going to help him in confronting inflation is a lower oil price. So I think let's get ready for peace, and I like peace very much, so I'm very, very happy with that.
Yeah, I think maybe that's a good thing to close on as well. They've got the US election, which will be the focus now for sure. Next, I guess, week, just a bit more than a week. So that's going to be the focus. I think if it is Trump, he's made everything very clear in that he wants to see energy prices lower. That's the key for his inflation story. Do you guys agree? Anything else on the US election? Do you think it's pretty binary bearish, Trump getting in power? Or if he doesn't get in power, is that actually a surprise bullish event maybe?
I don't know if it's a surprise bullish event, but I do think a key point to look over there is just if there's, I don't know how the Middle Eastern story is going to look like with another Trump presidency, with his relation with Iran in his first presidency as well. I think that's going to be, I don't know if we're going to see a potential surge in the tensions in the Middle East before we finally see a potential ceasefire deal or just something get better eventually. I personally believe with the Trump presidency that could get a lot worse, the geopolitical risk premium. But yeah, that's just what I think.
Yeah, no, fair enough. Harry, any parting thoughts?
Just to reinforce a couple of things that Jorge pointed out, it's quite interesting, and people don't talk enough about this, is that we've had diplomacy developments between Saudi Arabia and Iran, with Iran's foreign minister received no less than by NBS. And so I think, when you start having those kind of relations develop in the region, the chance that Iran may orchestrate another attack on Saudi oil infrastructure is greatly reduced. Then after that, we're talking about macro narratives. Obviously, the US presidential election is coming up. And you can't really say that a Trump presidency or second one could be uniformly bearish or bullish. There are a lot of moving parts here, and they pertain to foreign policy, whether that's with Russia, in the Middle East. They pertain to implementation of sanctions on countries such as Venezuela and Iran. And I would say there's also economic policy choices that are also a matter of foreign policy, with tariffs that could impact global economic growth. So there are a mixture of things, and fallouts from the second Trump presidency. But for now, the betting markets are giving Trump an advantage. The market is reacting, believing this would be inflationary, even though inflationary expectation measures by the markets, like 5-year break evens or US inflation swaps for 5 years, are not really showing that. It doesn't matter. You have portfolio hedging that's driving a lot of flow in the bond market, and that's helping to push up yields. And that'll give us, possibly a stronger dollar. And something that I was referring to earlier, stronger dollar environment is typically not favorable for oil-denominated commodities, including oil, of course.
Great. Okay, Martha, anything?
I think that sorry. I think that it will be interesting to see that, harking back to April again, these kind of step-by-step de-escalations where like said the saving face hits, where like Iran have said they are going to strike. Whether this is just talk or not, it is important to check for volatility there. I think especially if the market sells off, unless there is that kind of rebalancing, we'll have a very short market again. And if they do, strike as they say they're going to, unless it's touch wood like we saw in April where it was de-escalation by, bit by bit, then this could be a point for volatility and a point for maybe some upward momentum, because there may be little else.
Okay. Well, thanks for giving up your Sunday evenings. I'm sure you'd love to be here on a Sunday. And thanks everyone else. Thank you, Jorge. Thank you, Harry. And thank you listeners out there for our first proper live show for oil. We do it Macro Mondays, but and if you'd like this and you want more of this, we're here to do things like this, and this was a bit of an experiment and we've enjoyed it. Well, I've enjoyed it. Don't know about you guys. You'll say you did.
Oh yeah.
Yeah. And we will see you all next week for more continuation of our normal stuff. So thanks, guys. See you again soon.